Thanks, Cedric, and good afternoon to everyone in Asia. Good morning to anyone listening in any other part of the world. Just picking up on Cedric's points, let's talk about, there are two types of specialize in here as the voluntary one, or what we refer to as the global carbon credit market. And this differs from compliance markets in that the driver of buying activity is largely corporates. And these corporates will set climate objectives, climate targets, partly under self-initiated, but also partly under pressure from a variety of stakeholders. And those stakeholders can be the public, they could be NGOs, they could even be shareholders, or even sort of soft influence from regulators. And Kaisa will talk more about that. But if we look at the number of commitments that corporates are setting themselves in the climate field, a key organization that tries to provide the standard for corporate climate action is the Science Based Targets Initiative. And you can see that in this chart, the number of companies signing up to science-based target is now over 4,000, nearly 8,000 firms globally. And these are some of the largest firms in the world. And if you look at the emissions that they are covering, their scope 1, which is the emissions they emit directly, scope 2, which is the emissions from the electricity they consume, and 3, which is the emissions from their supply chains upstream and downstream, it comes to around 24 gigatons. Now, if you're not in the climate world, that may not mean much, but if I say it's about half of the world's greenhouse gas emissions, you can see that corporate intention on climate has been increasing and continues to increase. In that group, the Science Based Targets Initiative, there are different types of targets, and the most important one of those is the net zero target. And so it's a subset of the chart on the left. It's about 2,500 firms with a carbon footprint of about 10 gigatons. And the difference between validated and committed is about 800 firms have had those science-based net zero targets validated. There's another 2,000 that have got an intention to get those targets validated by the SBTi. But you can see a similar pattern, that there's a sort of increasing number of companies showing goodwill and good intention to set targets. Now the question is, how will they do that? Because a net zero target means reducing emissions to zero by at least 2050. And that is a tough objective for any firm when the current economy of the world is mostly based around fossil fuels. When in MSCI, we track not only the SBTi companies, but thousands of other companies, and in particular those that are listed on all the public exchanges. So about 9,500 firms. This is the MSCI Net Zero Tracker. And then this chart shows 3 different types of targets, with all climate targets, self-declared net zero targets, because not all net zero targets are endorsed by the SBTi, and then the ones that are under SBTi. And you can see a similar pattern in the ones at the bottom of that chart that are increasing. About 20% of publicly listed companies globally now have an SBTi climate target. But interestingly, those outside the SBTi, just self-declared, sort of self-interested targets, are sort of somewhat plateauing, but overall about half of the world's publicly listed companies have some form of climate target. And that intention is driving a lot of activity. Now, in our world, we look at what a carbon credit is and how that supply and demand will come together to create a market. And just to sort of back off one step, what is a carbon credit? It is effectively a reduction in emissions based on something that would otherwise have happened. So, if, for example, we can claim a project developer can claim carbon credits from protecting a forest, which is a good thing, then the credit is the difference between the carbon retained in that forest and how much would have been released had they chopped them down. So that concept is fairly intuitive, but in practice, opens up a host of challenges in measuring that carbon credit, particularly in relation to the threat, in that example, that the forest would have been under. So you've got to quantify it, you've got to establish a baseline, and the projects need to be validated and externally verified. So there's a number of checks and balances in the system. You may have seen or heard of some news stories around the integrity of some of the credits. That's all in relation to some of these calculations and assumptions that go into it. But that's the basic idea. Something that's good for the climate can register, get a credit, and then that becomes a tradable asset and can be used by corporates in various ways. We track all of the demand for carbon credits. We monitor which companies are using what. This is a chart going back to 2020, showing the number of carbon credits being used by corporates for a variety of purposes to make various environmental claims. The color code is consistent throughout this presentation, that green is nature. So we have nature restoration projects, growing new trees. Red plus is reduced emissions from deforestation, and then renewable energy, energy efficiency, switching fuels to lower carbon fuels, and then non-CO2 gases, which is like methane control. So in spite of some of the media concern around sort of the integrity, we've seen corporates continuing to use carbon credits for their, largely to improve their reputation. It's a nascent market. It's relatively small at the moment. We calculate it's worth about $1.5 billion in the primary market last year. We expect that to grow. Our models show that there is increasing potential demand in the future. And that is just the primary market. So it ignores the secondary trading of these credits, which could be to the 2 or 3 times that. So it is in early stages, but there's a lot of hope pinned on where this market can go in the future. We run models, we run forecasting models that look at where the future demand could come from. We add up all of the commitments and all of the potential need for carbon credits from the companies in SBTI. There are a number of oil and gas companies which have set very ambitious targets which don't subscribe to SBTI. There's companies which are just making claims around carbon neutrality. There's sovereign demand at the national level. There's compliance demand creeping into some countries like Singapore, Japan, Australia. And then this the Corsia is a scheme in the international aviation sector, which is trying to keep emissions constant at 2019 levels, or 85% of 2019 levels. So any growth in international aviation emissions beyond that level needs to be compensated for, reduced or offset to some degree, and they will use carbon credits largely to try and achieve that. So that really puts international aviation under the spotlight. And these are our scenarios going up to 2050. We run probabilities around those, and we look at low, medium, and high growth scenarios. But the overall picture is, if you subscribe to the view that companies will follow through on their climate commitments, then there's a substantial growth ahead. Put that in context, the median projection by 2050 would be around 10% of world greenhouse gas emissions would be covered by these corporate commitments, and the use of carbon credits under our medium scenario. So it's got the potential to make a big impact in the world, and that's sort of what a lot of the industry is planning for at the moment. Looking at the supply side, often we get asked, are there enough credits? Will there be enough projects? Well, the answer is at the moment, yes. There are about 6,000 projects in sort of major projects that we track in the world. Another 4,000 if you look at the small end and more boutique end. And together, we look at the projections of how many credits those projects could produce, and there's a growing supply building at the moment due to a lot of investment that happened in the last 3, 4, 5 years. A lot of those are registered. Some are just in the preparation stage, and you can see from the shape of these charts what the future issuance potential profile is likely to be. And on the right hand, you can see the split by project type. So the green ones are nature-based projects. And whilst they may account for about 30–40% of project activity today, the nature-based component is looking to take an increasing share of that market. Nature-based projects, protecting forests, for example, are long-lived projects, and they have sort of long lives, so they continue, whereas other projects may come off the end of the conveyor belt and need replacing more frequently. So there's a lot of modeling that we do around that, but in short, there are enough projects, particularly over the next sort of 5–10 years, to meet a lot of the potential demand. If we look at the location of these projects, there are all around the world. This is a map of every single project that we track. You can see North America, South America, but also in Asia. There's a high density of projects in Asia, India, China, Southeast Asia. We've excluded from this chart all of the projects in Australia because they come under a separate scheme, but there's still a lot of projects in Australia as well. Together, all of those projects in APAC, Asia Pacific region, account for just over 50% of project activity in the carbon credit market globally. And if you look at the nature-based projects, 55% of all project activity, so growing new trees, protecting mangroves, protecting existing forests, is active in the region. So there's nearly 1,000 nature-based projects scattered across China, Southeast Asia, relatively few in India, actually. India has mostly gas-based projects, so renewable energy, energy efficiency type projects. But certainly in the Pacific Rim, nature is a key project type for obvious reasons. But these nature-based assets are now being monetized more and more through international finance created by the carbon credit market. What's going on with prices? This is our weekly analysis of prices within the market. We've seen them come off a bit since 2023, and these are the prices of different project types. So nature restoration had a very buoyant year in 2023. It's come down a little bit, $10 to $12 per ton now, compared to sort of $18, $20 seen in the first half of last year. The other project types, more stable at around $3 to $6 at the moment. But there's a lot of variability in those project prices. And increasingly, investors are taking positions to take equity and take long-term commitments to buying the credits off the back of them. And that sort of takes some volume away from the secondary market, which this is a chart showing secondary market activity. And those longer-term offtakes are tracked by our team in a slightly different way. And this chart here shows the range of spreads. So those previous prices are just the weighted averages. This shows actually in certain sectors, so nature restoration, you can get much higher prices for certain project types. And this sort of is a feature of this market where the specificity of the project really drives its value rather than it being, a globally traded commodity. And so there's a lot of variability in the project prices. You can get up to $35, maybe more, for a certain type of nature-based project with very high quality, very unique attributes, very good biodiversity, for example. Energy efficiency has a large range. Red Plus, the nature protection ones, also can range depending on the project types. So when one sees an average price of, say, $5, $6, $7, that sometimes hides a significant range of prices underneath. Overall, we've tracked this industry over the last 10 years, and we've calculated it's received about $36 billion worth of investment in carbon credit projects. And 18 billion of that has been in the last 3 years, 2020 to 2023, and over 40% in nature-based projects. That sounds good. It sounds a very positive step for the climate. However, it's only a third of the level that we calculate would be needed by 2030 for all the companies to hit their climate targets. So there's still more capital going to be required. What it means on the ground is we've seen about 1,500 new projects registered since 2020. So that 18 billion is getting distributed across quite a few projects. And in the nature-based sector, it's resulted in about 30 million hectares of restored and protected lands, which is roughly the size of Italy. So, there's a real intensity of project activity happening as a result of a lot of this capital creation, this capital investment. I'm going to hand over to Kaisa now, who will take you through some of the patterns that we're seeing in the APAC region in these markets.
Thank you, Guy. So I'm going to talk about the policy outlook for APAC carbon markets. So I would say one of the key developments in the 2020s is that APAC governments have been taking an increasingly active role in the carbon markets. Many of them are establishing carbon pricing instruments, which are mandatory emission trading systems, which we call ETS, or direct carbon taxes, as you can see on this map. Existing schemes are also expanding. China's national ETS is set to surpass the EU ETS as the world's largest compliance market within the next 2 years, as it extends to cover more sectors. China is also preparing to open its compliance market for more voluntary participants and to introduce carbon derivative products based on ETS allowances. These developments will contribute to further maturing of its ETS market. The development of domestic regulated markets is mainly driven by 3 key factors. Firstly, nationally determined contributions under the Paris Agreement and the Article 6.2 cooperation mechanism also established in the Paris Agreement. In their NDCs, countries have set emission reduction targets for 2030. Getting on track towards these targets is becoming a higher priority for many countries as we approach the midpoint of this decade. Governments aim to use carbon pricing as a tool for accelerating decarbonization. And there's another way in which the Paris Agreement is contributing to carbon market development. Article 6.2 of the agreement establishes a bilateral carbon trading mechanism, which allows countries to buy or sell emissions included in their NDC inventory. And secondly, the EU's carbon border adjustment mechanism, essentially import carbon tax, is pushing many APAC countries to introduce carbon pricing more urgently. The CBAM is set to take effect from 2026 and will impose carbon taxes on industrial products imported to the EU. The export-oriented industrial sectors of many APAC countries are facing significant losses of revenue from this. However, the CBAM levies can be reduced if carbon pricing has already been applied at the country of origin. As a result, many APAC countries are now trying to align their carbon pricing systems more closely with the EU's to mitigate the impact. And lastly, ambitions to participate in the international carbon market are also shaping domestic policies. Many APAC governments are aiming to sell credits from their domestic market to the global voluntary and Article 6 markets. Some countries also plan to open their national regulated markets to international voluntary participants or establish themselves as global hubs for voluntary trading. To support these ambitions, governments are creating regulatory frameworks for voluntary carbon crediting and trading. This marks a departure from the 2010s, when the VCM was largely unregulated and highly globalized, with international carbon standards such as Vera or Gold Standard used to generate credits across countries and regions. Now, these international VCM standards are increasingly coexisting with national crediting standards. These national crediting mechanisms are often used to generate supply for the domestic regulated markets. Selling domestic credits to international carbon markets can also provide a new source of revenue, although this requires addressing some policy challenges. Domestic carbon standards must be aligned with international standards or regulations, or they may not be eligible for exports. Governments must also ensure that international carbon trading does not impede progress towards domestic climate commitments. And APAC has emerged as the global hotspot for cooperation agreements under the bilateral Article 6.2 2 mechanism. These agreements indicate that the countries plan to trade emissions directly between each other. The seller country generates and transfers the credits, and the buyer can count them towards its NDC target under the Paris Agreement. The Article 6 market is still taking shape, but the first 6.2 transaction has already taken place with an Asian country as the seller as well. Last December, Thailand transferred credits to Switzerland under this mechanism. While the buyer in that case was European, there is also significant demand for Article 6 credits within the APAC region. This is driven by 3 countries, Japan, Singapore, and South Korea. While they all have cooperation agreements with both regional and global partners, their closest partnerships tend to be with other APAC countries. The Article 6 market is still at an early stage of development, and regional trading dynamics will become more complex in the longer term. Many countries in the region straddle the line between the buy side and sell side and could engage in both types of activities. For example, Indonesia might import credits from other countries to support its NDC commitments, while also exporting credits to the global market. This will depend on factors including the level of domestic supply and demand, price differences across these markets, and forthcoming Article 6 trading regulations. And on this slide, I've created some groupings to illustrate the diversity of APAC countries' approaches to international carbon trading. These approaches broadly correlate with the country's economic status. Emerging economies have usually set NDC targets that are fully or partially conditional on international finance, and selling carbon credits can provide a way to access this in line with the Paris Agreement, which is why towards the left-hand side, we have least developed countries and middle-income countries. Conversely, wealthier economies are committed to funding their own NDCs, as well as contributing to mitigation and adaptation overseas. These commitments can also be supported through the carbon market. Aside from economic status, carbon trading approaches are shaped by NDC ambitions and policy priorities. These considerations vary significantly, even within similar income groups. In the high income group, for example, we can see at least 3 distinct approaches. Japan and South Korea have established their own mechanisms for generating credits both inside their own jurisdictions and overseas. Singapore has not established its own crediting mechanism, but instead is choosing to procure credits issued through international standards in other countries. And Australia is currently more focused on its internal market and has been less active internationally so far. Similarly, approaches could and likely will vary across the large emerging economies of India, Indonesia, and China. None of these countries have yet finalized their policy on international carbon trading. These countries are currently prioritizing domestic market development, but could export significant quantities of credits in the future. The way they choose to align their domestic and international carbon markets will be one of the most impactful policy developments to look out for in the region. And lastly, I want to touch on the implications of these developments to investors in APAC carbon markets. In terms of risks, the establishment of carbon pricing systems can obviously incur compliance costs as well as non-compliance penalties. Keeping track of the local regulations and carbon pricing outlook is increasingly important in the APAC region to avoid negative operational impacts. At the same time, the presence of compliance markets can bring business benefits too. Carbon pricing incentivizes faster decarbonization, which can enhance companies' brand image and bring other tangible benefits, such as improving supply chain resilience. Participating in emissions trading can also support business strategies in itself, particularly in systems that allow voluntary participation in secondary markets. On the voluntary side, the main risk in APAC countries is currently the uncertainty in many countries around how the domestic and international markets and crediting standards will be aligned. In most countries that are establishing their own voluntary crediting mechanisms, it is still unclear whether these credits can be easily traded on the global carbon markets. Some countries could establish export restrictions to ensure that international trading does not interfere with domestic targets. Restriction or authorization requirements could also be applied to projects under international VCM standards in some of these countries. So the key question for investors is how open will these markets be, as this will shape the outlook for international trading. This uncertainty will likely be mitigated over the next 1 to 3 years as key countries are now finalizing their carbon trading regulations. In the meantime, APAC carbon markets are already growing fast and presenting significant opportunities for investment. Several countries have established supporting policies to facilitate private sector participation in their carbon markets. Public-private partnerships are also proliferating in many APAC countries as governments take a more active role in the voluntary carbon markets. I'll stop here. If you're interested in more detailed analysis of these developments, please check out our country profiles and policy risk and opportunity assessments if you haven't already done so, or ask me a question in the Q&A. Thank you very much, and I'll hand over to Milo.
Hi everyone, and thanks Kaisa. It's clear from your presentation that these markets are not the simplest to understand. They are a very complex landscape, and I'm here to talk about how MSCI Carbon markets can help with companies that are trying to navigate this ever-changing space. I will now share my screen and go through a live demo of the platform, which outlines exactly how some of our customers are using the platform to answer these questions and to explore carbon markets further. So you'll see here the MSCI Carbon Markets platform. This is a tool that we've developed over the last few years, working with our clients to understand the needs of them to further develop everything that we're doing in the space and to provide clarity over everything across the carbon market ecosystem. You'll see here 6 core pillars that make up the platform that cover everything from corporate data and how companies are engaging with the space on a demand side perspective, through to carbon credit prices and how transactions are occurring in the market, going all the way through then to how we expect prices to evolve over time in carbon market forecasts. Additionally, as Kaisa mentioned, we cover a lot of analysis on policy and guidance, particularly on the jurisdictional level, as well as looking at more of the quasi-compliance that comes from organizations like Guy mentioned as the SBTI. The last 2 sections of the platform here, carbon projects and transactions and also carbon credit integrity, focus more on the supply side and the projects themselves and how companies can learn more about what's happening in the market, both at a macro level and also at a micro level for individual projects. Now, I think the best way to show the platform is to go through a real life example of how one of our customers might engage with the space. They'll use our expertise and the one-stop solution that we've generated in order to understand the market further and potentially engage with carbon markets more in the market. So I'm going to click through here. Here you'll see the carbon map that Guy referenced earlier. You'll notice that there are thousands of projects here, and for a customer it might be hard to understand exactly which project they should invest in, they should use for corporate climate targets, or they should trade potentially as an intermediary body. So what we do here is provide information on all of these projects. And importantly, we start to look at integrity. Integrity or quality of projects is increasingly important as a lot of projects come under scrutiny and are in the spotlight in the media. So we've provided a solution that looks across the whole market to understand the integrity of these projects. You'll see here over 5,000 different projects that have been scored by the MSCI team, including experts across forestry, renewable energy, clean cooking, and other project types to help generate these scores to help our customers understand how they can navigate this market and which projects might be worth exploring further. If a customer decides that they have specific requirements, say in APAC, they might look at projects in the local region, they might look at Southeast Asian projects, and perhaps they have a particular interest in nature-based solutions. If that's the case, they might find themselves looking through this dashboard and finding a project similar to this following one. This is the Katingan Red Plus project in Indonesia, and we have scored this project across a number of different criteria, including additionality, quantification, permanence, co-benefits, and also, unique to MSCI, legal and ethical concerns. So this is made up of about 50 different subscores that cover the whole project, and we essentially score these using information that is both publicly available and through working directly with project developers to better understand the ins and outs of projects on the ground, as well as using geospatial data, particularly for understanding biomass stocks and estimating the carbon emissions reduced or removed from these projects. You'll see here that a customer might decide that this project is of interest to them, and they can then further explore the various different sections here available, whether that's understanding further insights into additionality or understanding perhaps who or how much this project is trading and potentially how much they are trading for as well. So we have examples, as you'll see within the various buttons here, of how you might be able to engage with this project and how others are also engaging with the project. Beyond that, if there are further questions from our customers on perhaps trading of these credits or again project development of similar projects in a similar region, you might have concerns about policy. Now, the policy landscape, as Kaisa mentioned, is ever changing, and this solution and the work that our policy team do allows our customers to get insights across the market, whether that's on carbon trading and restrictions, policy infrastructure, forestry regulations, and other key areas. This allows them to essentially understand what's happening in the market and be better prepared for any long-term investment decisions and trying to avoid getting caught out in these integrity concerns that people often have with this market. Beyond that, we can also start to look at how much a credit might actually cost. You'll see here, I'm showing one of our carbon credit indices. So this index is demonstrating the various prices of REDD+ credits that are traded in the market. MSCI works with a variety of different sources, through from exchanges to project developers and brokers and traders who provide us with prices on a weekly basis, which we are then able to present to the market and provide further clarity on what is happening on more of a trend basis, as well as at a more granular level, looking at options for specific price estimates for particular projects and other areas of concern, such as integrity and understanding how prices vary based on the integrity scorings that we've given particular projects. This allows us to, again, show further clarity for the market and help to give our customers all of the information they need to make well-informed decisions surrounding carbon markets. Additionally, for the more long-term view of our customers, we have solutions for voluntary carbon market forecasting. With the expertise of the team in-house, we have developed the most comprehensive scenario analysis of the market, showing a variety of different options for our customers, be those restricted by quality in the supply side or potentially restricted by willingness to pay of different corporates. We're able to understand the variety of sort of scenarios in the forecasting space. You'll see here that we build up supply and demand to develop these forecasts and show the long-term outputs of where prices are expected to go. That's the main goal of this forecasting tool, and especially when we're looking at this, we're looking at prices going all the way out until 2050, which of course is a target year for many companies in this space, particularly engaging with the Science Based Targets initiative. So additionally, on top of that, if companies have decided that perhaps this project is for them, perhaps they're interested in buying, and they're interested in buying now, but also they have commitments for the future, you may see that they want to understand who else are buying these credits, and we have some of the most comprehensive analysis on that as well. So this next page, you can see here we have a database of all retirements by various companies. This is actually filtered for retirements specifically of Indonesian projects, given that this particular demo has been focused on an Indonesian project and Indonesian sort of country policy as well. So you can see which companies are engaging with this space, and particularly looking at projects in this country. Within that, we have company profiles, which enable you to see the individual behaviors of these different companies and understand them further to better benchmark yourself against your peers and potentially your competitors. So, in essence, that is the use case that I'm going through here of how a corporate or an investor might use the platform to better understand the market and to get an insight across various different pillars of the space. Not only understanding the simple dynamics of supply and demand, but what that means for price, what that might mean compared to your competitors, and also what the integrity of these projects are, which is so critical to our customers, particularly if they want to do their best at avoiding greenwashing claims. So with that, I will stop sharing my screen and we'll pass over to Guy for the next section of this discussion.
Thanks, Milo. There's an absolute treasure trove of information on that platform, so we hope that was useful, and by all means reach out to us with more questions. Alvin, are you there?
I am here, Guy. Thanks so much for having me here today.
Alvin, great to see you. Good afternoon from London. For those, Alvin, please introduce yourself very quickly.
Hi, everyone. Alvin. I'm based here in Singapore. I lead the Asia Environmental Products business at Morgan Stanley. So there we have a global team based in New York, London, and Singapore, trading and facilitating client transactions in compliance carbon, voluntary carbon, and renewable energy certificate markets. Thanks for having me here today.
Great. And Alvin, thanks for giving us your time. Really appreciate it. Alvin, you've been around this space as, not quite as long as I have, but nearly as long as I have. And you've seen a lot. And we've talked a little bit about, what's going on in the Asia region. You see it sort of really, at the coalface. What are your perspectives on sort of sources of demand in the carbon credit market and supply? And, what are the patterns you're seeing now in today's environment in the region?
No, sure. Happy to take that question. Actually, Kaisa did cover quite a bit of this in her presentation. I think, Guy, before jumping straight into answering the question, maybe I just want to set the context a little bit, because I think about this market with having the lens of three fundamental assumptions that I think are critical for us to expand on this topic. Right. The first assumption here is that we collectively as a world, we care about climate change enough to want to mitigate its impact. We often think of this as climate mitigation. The alternative to this is something called climate adaptation, which for me is a localized solution. Climate mitigation is a global problem, global solution. The second fundamental assumption is that carbon markets as a market-based mechanism, so being able to trade market-based mechanism, is the preferred regulatory tool to finance the transition. There are actually alternatives, carbon taxes, subsidies, policies that tighten environmental standards that could get us to the same outcome, but they are not market-based mechanisms. So we believe that we want to use a market-based mechanism. That's the second fundamental assumption. The third fundamental assumption for me is that project-based carbon credits, often like those we use in the voluntary carbon markets, are necessary in a net zero world, because there will inevitably be some high-emitting industrial sectors that cannot decarbonize completely and will have to rely on carbon removal technologies. So I'm always looking at this market from these three fundamental assumptions, the lens from this. Now, in Asia specifically, Asia has historically been a source of supply for carbon credits rather than a source of demand. But like what Kaisa mentioned, where there is demand, often it comes from the supply chain or compliance obligations as opposed to voluntary. So I'll give you some examples. In the airline industry, there's something called CORSIA, and Asia is home to some of the largest international airlines that will have to comply with the airline industry's commitment to keep its emissions below a 2019 baseline level. So I expect demand from airlines in this region who are serving international routes to be buyers of project-based carbon credits to meet their CORSIA obligations. Now, one of the challenges with CORSIA today is that it requires these carbon credits to come with something called a corresponding adjustment, which is an accounting entry made by the host country where the carbon projects are cited, and they are in limited supply. The other example in Asia where we see demand is in the markets where there is a convergence between project-based credits into compliance carbon programs. This is true in China as it is in South Korea, Japan, Singapore, and Australia. So if I'm based in Singapore, so I'm going to give a Singapore example. In Singapore, we have a carbon tax. It used to be 5 Singapore dollars up until last year. It's $25 in 2024 and 25, 45 Singapore dollars in 2026 and 27, and then rising to between 50 and 80 Singapore dollars in 2030. Singapore also allows then the use of international project-based carbon credits to offset up to 5% of taxable emissions. Now, what does this do for the market? Firstly, it creates a price signal. It tells market where prices are going to be till the end of the decade. Secondly, it creates a permanent and regulated demand base, thereby channeling capital towards carbon projects that would be eligible for use in Singapore. And thirdly, it reduces the policy risk and uncertainty around the eligibility of projects. So this is an example of how one of the APAC countries here in Singapore are using project-based credits in their compliance program. And we're seeing that kind of proliferate across all of Asia Pacific. And I think for those on the call, I think the MSCI team has done a tremendous amount of work and analytics around tracking of supply and demand of these carbon credits across the voluntary market, CORSIA, and whether or not these projects are also then eligible for use in the compliance market. So I'm sure Guy and his team can probably provide you with more color in this on this topic either now or later in the Q&A.
Yeah, thanks, Alvin. I'm going to go a little off-piste on this one. That's good summary, really good summary, I think, of what's going on in the region. Now, we've all seen the media. We live and breathe this, the carbon market world day in, day out. Just want to touch on sort of this issue of credibility. And you mentioned like the Singapore situation where, these and the airlines, which are relying, if you're an international airline, you have very few options to sort of make a dent in your emissions. Sustainable aviation fuels, maybe rerouting, maybe slightly more slightly better planes, but those are going to take, that's going to be a sort of a drop in the ocean, and it's going to take many decades for that technologies to come through. In the meantime, the offset market, the carbon credit market, is the only really kind of legitimate source. But for them to make sure that those credits are viable and legitimate and genuinely sort of creating those reductions, this whole issue of integrity, and there's been a lot of work on the supply side of the market, the Integrity Council on voluntary carbon markets, the standard setting bodies. What's your sort of sense about how much effort is going into ensuring, the integrity of the credits that are actually being traded now?
There's a lot of work going to this space, but Guy, maybe I can split your question into two parts. One, you talked about the airline industry and the ways that they can decarbonize. This is not unique to airlines. It's something that affects all sectors. If we think about the new technologies that needs to come into this market to help decarbonize the global economy and go through the energy transition, a lot of these technologies are new. In the airline industry, sustainable aviation fuel is one of those technologies, but it will take time for it to mature. And in the interim, do we say corporates, airlines don't do anything? Or do we use an alternative from project-based carbon credits as a way to compensate emissions? I think the trend right now is that airlines and other corporates are using carbon credits as a way to compensate immediate emissions that are unabatable as they develop these within supply chain technologies. On your second question around quality, like you rightly pointed out, there is already an industry program called the Integrity Council for Voluntary Carbon Markets. They developed something called the Core Carbon Principles, which help define what is considered a high quality carbon credit. But there are also other regulated programs that do the same. For example, under CORSIA, the International Civil Aviation Organization, ICAO, sets some parameters on what type of credits airlines are allowed to use within the CORSIA scheme. So airlines have to comply and buy credits that meets that criteria. Again, looking back where I am in Singapore, the Singapore carbon tax allows the use of international carbon credits. And those international carbon credits go through a white list that have been pre-filtered by the regulators here. So there are efforts both at the government level, at the industry level, like with CORSIA, and also with voluntary corporates through the ICVCM core carbon principles to ensure that credits bought are of high quality.
Yes, and I think that's certainly sort of the pattern across the world as well. We're seeing, certainly from the work that we do with the standard setting bodies, a real focus on trying to make sure that the standards and the measurement processes. There's a lot of satellite technology being used now to make sure that the credits that are traded are high integrity and are doing what they say they're going to do. Now we've spoken a little bit about the supply side, the projects that are going on in the ground. We've spoken about the corporates, the airlines or the industrial companies that are really in the firing line. And then there's a third group, which is the asset owners and the asset managers, who are sitting, looking at their corporate portfolios, looking at the strategies, the obligations, the risk. Kaisa mentioned the risks and opportunities depending on what jurisdiction you're in. Do you have any thoughts on how asset owners and asset managers should be sort of considering this sort of growing sort of set of dynamics?
Absolutely. I mean, before I was at Morgan Stanley, I was actually an asset owner thinking about this problem. So I really need to start with why. Why should asset managers and owners think about carbon markets and decarbonization? In assessing climate risk, investors typically consider two types of climate risk: physical and transition risk. And within transition risk, we want to look at something called policy risk, which I consider to be the simplification of all global policies into a theoretical carbon price. If we believe that this carbon price goes up over time and then results in lower operating income from portfolio companies, think if you own an MSCI equity portfolio, because those portfolio companies are unable to achieve cost pass-through on the rising carbon price, then one way to mitigate that risk is to buy carbon as an asset class. So in October 2021, GIC, the Sovereign Wealth Fund here in Singapore, the Singapore Economic Development Board, and McKinsey published a joint paper to discuss how carbon markets are rapidly emerging as a viable asset class. This paper suggests that institutional investors could play a critical role in helping corporations and nations use these markets to achieve the global climate goals, whilst also fulfilling their own investment mandates. So I want to talk about three things that this paper had talked about. The first one is that carbon markets are approaching critical mass from an investment perspective. If we look at the emission trading systems that are most mature, the compliance markets in Europe and California, they've been established for over a decade, and over the last 3 years, each year they have consecutively traded over $1 trillion in notional value. In these markets, you can trade billions of dollars a day. Now, the voluntary carbon market or the project-based carbon market is a bit smaller. This market is about $2 billion today, with an expectation that it will grow based on industry numbers to about $100 billion by 2030 and $250 billion by 2050. So carbon markets as an asset class and compliance and voluntary is an investable category. The second point I'll make is that functioning carbon markets are essential to reach the globally agreed target of keeping global warming under 1.5 degrees. I mentioned earlier that the second fundamental assumption I have is that we want to use carbon markets as a market-based instrument to facilitate this transition. And then companies do not only have the obligation to decarbonize their own operations and value chain, but they should also compensate and neutralize their emissions on this path to net zero through high-quality carbon credits. And the third point in this paper, which is one more around diversification and risk returns, is that carbon markets offer an important opportunity for institutional investors to manage risk-adjusted returns. So if an investor were to allocate even a small portion of their portfolio to carbon allowances, think about California carbon, EUAs, carbon offsets, this could improve the resilience of that portfolio against climate transition risks. And in scenarios involving an immediate or delayed climate action, a hypothetical 5% carbon inclusion in a 60-40 reference portfolio could enhance returns by 50 to 70 basis points by over the 30-year period, or reduce volatility by 30 to 50 basis points. So there are diversification benefits from a risk-return perspective too.
That's great perspective, and I think your background sort of being in the asset manager industry, asset owner industry, and now in the in the actual transaction side of it is incredibly useful. So thank you for that. Cedric, can we go back over to you, and do you want to sort of fire some questions at us and that have come through on the Q&A side of things?
Certainly. No, thanks a lot. Thanks for all the presenters, and thanks for Alvin for answering all of these very fascinating questions. So actually, we received a lot of questions in the chat. Some of them actually related to the material, so please rest assured. So a link to the recording and the slides will be shared with you, right? And they will be available also on the on-demand section of our website. Maybe I'm going to try to go in the reverse order. So I'm going to start maybe with Milo. There's a few questions around what Milo showed us in terms of the platform, notably related to the integrity module. So let's say I'm an analyst. How can I verify or access the quality of carbon credits based on public information? And then if Milo can speak also a bit on the different factors that we have in that integrity module.
Sure, thanks, Cedric. Yeah, there are a number of different factors that we focus on. Probably too many individual ones to mention, but I think there are sort of two clear categories that we focus on, which are the carbon specific factors, which are additionality, quantification, and permanence. So essentially how additional the project is to environmental change, how well that project is measured or quantified, and then also how permanent is that reduction or removal in CO2. So that's sort of the first half, and then we also look at the other sort of non-carbon aspects of the projects as well. So the legal and ethical factors, so anything around sort of financial risk, anything to do with fraud or red flags or media sentiment with these projects. And then additionally, we look at co-benefits as well. So UN SDGs, other sort of measures like the CCB status of biodiversity of different projects, and various sort of outcomes to the societies around these projects as well. So we focus on a number of different factors, and we bring these all together in our solution. And if you want to find out more about the ins and outs of that, we'd be more than happy to talk through that on a follow-up call.
Thanks a lot, Milo. So I'm going to go to you, Guy. There's a few questions around the price of carbon credit. So as one should understand the price of carbon credits, and I guess it comes down also to the source of data, right? So if you can tell us a bit more about this.
Yeah, so as Milo sort of mentioned, we have an extensive sort of network of contacts in the industry. Using the exchanges, we have relationships with the main exchanges that trade secondary credits, and also brokers and traders and project developers and corporates. And we collect that data on an anonymized basis. We've got very strict NDAs that mean the private data is retained data, but only aggregated and anonymized through presentation of the indices. And we have about 20 different sort of sub indices of different project types. I showed the 5 main categories, but those then descend into subcategories. And so it's a big sort of data capture process that we run all the time, and we're always interested in bringing more information into the platform and including more partners that collaborate with us on sharing this information. And it's a very sort of symbiotic sort of relationship that we have with the market, and a lot of those quite often those pricing indices are used internally for reference points or potentially in contracts, to provide reference prices for off-takes and those kind of things.
Excellent. Thank you. So I'll move to Kaisa, right? So your section actually drew quite a few questions, interesting questions, notably in some of the latest trends. There were some questions notably focusing on Indonesia, right, and the future of carbon credits. And then I don't know if you want to comment, or Guy as well, in terms of APAC as a whole emerging as a global hub for carbon markets. So 2 questions into one here.
I'll let Kaisa take the first one on Indonesia.
Yes, so I think Indonesia is a perfect example of the sort of question I was discussing earlier of sort of alignment of the domestic and international markets, because what's happened in Indonesia is essentially that since 2021, I think they have started proactively developing their domestic market, a regulated market, and both a compliance and voluntary market, including a crediting mechanism. And so now the government is prioritizing ensuring that they get the domestic market going and there's no interference to their domestic targets from international trading. And so they're trying to do all that first, establish all the supporting regulations. And while they're doing that, since 2022, they've actually essentially suspended or restricted issuances and trading under international carbon standards. And so it's caused a lot of disruption, but the government is committed to establishing the supporting regulations necessary to allow the operation of international carbon projects alongside the domestic projects again. But it's not yet clear when these regulations are going to be issued. Some market participants believe later this year, but there's no confirmation. So we'll just have to wait and see. I hope that answers the question, but it's complicated essentially, but hopefully we'll have more clarity soon.
And then, thank you, Kaisa. If I could just pick up the second part of that question, which was APAC as a global trading hub. And one of the most fascinating things about this whole market is the amount of interest from across the world in this. So, Alvin, you're sat in Singapore. Singapore has made a very sort of clear statement that it sees the value in this, and wants to sort of be a focal point for a lot of trading activity. Malaysia has set up an exchange for the auctioning of credits. We've got schemes in Australia, Japan carbon crediting mechanism, and those are just ones off the top of my head. And that's just in APAC. In the Middle East, we've got Saudi setting up a voluntary carbon market platform. We've got schemes popping up in Brazil to set up, allow trading of mechanisms around Brazil, Ecuador, Colombia. These are countries. I'm ignoring Europe, which is like the big ETF, the big emissions trading scheme, who are really sort of fascinatedly, taking really strong interest in trying to create these markets to help both decarbonize, act as a point of selling the credits from those countries and getting international finance into those countries, but at the same time looking how that they can decarbonize their own economies. Because every country now under the Paris Agreement has a climate target. That didn't happen before 2015. So countries have got, a lot of the APAC countries have got these dual objectives. How do we decarbonize our country, and how do we get international finance drawn in to help that decarbonization process? And I think, Asia is such a fascinating center for all of that. But Alvin, the last word,
you.
We're just I think we're on time. Last word to Alvin, go on. Final comment on that APAC sort of big picture stuff.
I think you set it out really well, Guy. I mean, going back to my fundamental assumptions, one, we believe that we want to use these market-based mechanisms as a way to decarbonize the economy, and I don't think that that's contentious. And the use of project-based carbon credits is absolutely necessary in a net zero world. Again, that is not contentious. But where I think there's some areas for debate and still being developed, especially in Asia Pacific, is for the revenues that we generate from compliance markets, be it through tax or emission trading system, how do we then channel those revenues towards decarbonization activities, either within the country or globally with international carbon credits? And that is where I think the debate is right now. But the use of carbon credits or market-based mechanism are often not debated. I think the market has moved forward from there.